If you're holding KKR stock right now, or even just thinking about buying it, you really need to hear this.
Oh, absolutely.
Because right now, the entire financial media is basically writing the obituary for private equity. I mean, if you look at the broad market narratives, you'd think the entire alternative asset space is just completely frozen.
Right, yeah. The consensus view is just incredibly bleak.
Exactly. You hear that debt is too expensive to finance new deals. The IPO window is shut tight, so nobody can actually exit their current holdings. And then on top of all that, retail investors are supposedly demanding their money back en masse.
Fleeing to the safety of, 5% treasury yields.
Right. Fleeing private markets completely. But here's the thing. We have the Q2 2026 earnings transcript for KKR right in front of us, and the data tells a completely contradictory story.
It's like they're operating in a completely different reality.
It really is. I mean, they are posting blowout numbers. We're talking 70% profit margins on their fee revenue, realizing massive exits, and sitting on, wait for it, $72 billion of unactivated capital.
Yeah, that disconnect is arguably the most fascinating dynamic in the market right now.
Yeah.
Because when an entire industry is supposedly going through this, structural contraction, and one of the largest players is just casually hitting all-time historic highs.
Well, across the board, basically.
Yeah, across all their primary operating metrics. It really forces you to look under the hood. You have to figure out if the whole narrative is just wrong, or if this specific firm somehow built a mechanism that insulates them from the rest of the industry.
And that is exactly our mission for this deep dive. We're cutting through all the Wall Street jargon. We're going to bypass the standard, PR summaries and look directly at the real operational mechanics driving this quarter.
We want to deliver a really rapid-fire, data-forward analysis of these numbers.
Exactly. So we're going to hit the headline metrics, dissect how they're physically generating these returns in such a hostile environment, look at management's future guidance, and give you the actionable bottom line on what this means for the stock.
Right. Getting straight to what actually matters for you as an investor.
So let's just jump right into the headline numbers, because the immediate data from the quarter is just aggressively strong.
It really is.
Fee-related earnings, which they call FRE, came in at $1.32 per share. That is a massive 34% increase year over year.
And that 34% growth in FRE, that's basically the anchor for the entire bull thesis on KKR right now.
Why is that specifically the anchor?
Because for a firm operating at this kind of massive scale, expanding your recurring predictable management fee stream by over a third in just 12 months, that's structurally huge.
Right. It's not a one-off performance bump.
Exactly. It demonstrates that their capital formation engine hasn't stalled out at all, despite everyone else in the market hesitating. And they didn't just grow that top line either. Total operating earnings hit $1.68 per share, which is up 27%.
Wow. And their adjusted net income.
That hit $1.63 per share, up 38%. And that number actually factors in the lumpier performance fees from asset sales.
Okay, so let's translate that for a second. We know that FRE, that fee-related earnings number, is the absolute premium revenue stream for these alternative asset managers.
Oh, for sure. It's the holy grail.
Because it's recurring. It's predictable cash they make just for managing money, regardless of whether the stock market is up or down that day. And because of that, the public markets attach a way higher multiple to it compared to the performance fees, which, can bounce around wildly.
Right. Performance fees are great, but Wall Street loves predictable recurring revenue.
But what really stands out to me here isn't just the sheer volume of the fees coming in, it's the retention of those fees. The transcript notes their FRE margin came in at a staggering 70%.
Yeah, that number is wild.
And they've maintained a margin above 65% for 10 straight quarters.
Sure.
Keep in mind, a 70% profit margin on fees, that is like a software company's economics.
Yeah, enterprise SaaS levels of margin.
Right. You only see that in businesses where the cost of replicating a digital product is basically zero. But KKR is doing this in high finance. They are literally keeping 70 cents of every dollar that walks in the door for managing assets.
It does seem pretty counterintuitive, right? Because alternative asset management is traditionally this highly bespoke, very human capital-intensive business.
Yeah, you have to pay the deal makers.
Exactly. Sourcing a deal, doing the due diligence, sitting on the board, engineering the exit, that requires highly compensated teams. But what KKR has done, and what their CFO Rob Lewin detailed on this call, is they've built this shared services platform that scales independently of their headcount.
Okay, let's break down the mechanics of that, because that operating leverage is fascinating. How are they adding literally billions in assets under management without just blowing up their expenses at the same rate?
It really comes down to the underlying architecture of the firm. Like back when KKR was a smaller, pure-play private equity shop, if they wanted to launch a new strategy, they basically had to hire a completely new team from scratch.
Which is incredibly expensive.
Right. But today, they operate with this highly integrated, centralized infrastructure.
So they share the back office.
More than just the back office.
Mm-hmm.
If their credit division launches a new collateralized loan obligation or, a CLO, or if their infrastructure team raises an adjacent Core Plus fund, they use the exact same centralized legal team, the same compliance team, risk management, capital markets team.
Oh, I see. So the marginal cost of launching, say, fund number 4 in a specific strategy is just a fraction of what it costs to launch fund number 1.
Exactly. The fixed costs are already totally absorbed by those massive flagship funds. So any adjacent products they launch, and they're launching them aggressively, just pour high margin revenue straight to the bottom line.
That is a brilliant model. But I have to question the sustainability of this a little bit. In the transcript, Lewin actually suggested that they don't view 70% as a ceiling.
Right. He hinted it could go higher.
Yeah, but if they push that margin to 75 or 80%, at what point are they under-investing in the actual talent? Wall Street is notorious for these intense compensation wars.
Oh, absolutely.
If you squeeze the margins too tight, don't you risk losing your top deal makers to Apollo or Blackstone?
You've hit on the perpetual tension in any publicly traded partnership. The public shareholders want the highest possible margin, but the employees want the largest possible bonus pool.
Right, the classic battle.
But KKR manages this by heavily utilizing equity compensation. They rely on the overall growth of the firm's balance sheet to enrich the partners, rather than just carving out massive cash bonuses from the management fees.
Okay, so they paid them in stock.
A lot of it, yeah. By keeping the FRE margin at 70%, they support a much higher stock price. And that directly benefits the employees who hold massive equity stakes, which is actually something we're going to dive into deeply later on because it's a huge part of the bull case.
Okay, yeah, we definitely need to circle back to that insider ownership. But you're right to point out that there is execution risk here. Keeping that operating leverage high requires incredible discipline with headcount, especially as they expand into these really complex new verticals.
Exactly. But this brings us to the operational reality driving these numbers, which is the story behind the data.
Right. Part 2 of our deep dive. The narrative is that private markets are stuck, the cost of capital is high, the bid-ask spread between buyers and sellers is too wide, so nobody is doing deals, but KKR is crushing it. So wait, every article you read right now says private equity is dead, no one is exiting deals, and retail investors are pulling their money out. How is KKR pulling this off?
Co-CEO Scott Nuttall actually addressed this exact narrative directly on the call, and I love the specific phrasing he used. He characterized the current alternative asset industry as K-shaped.
K-shaped. Okay, so borrowing from the economic recovery term.
Exactly. And that K-shaped analogy is just a vital framework for understanding the divergence we're seeing right now.
Because for the past decade, it wasn't K-shaped at all, right?
No, not at all. For 10 years, zero interest rate policy acted as this massive rising tide that lifted every single alternative asset manager. You didn't even need to be a brilliant operator to generate a return when debt was essentially free.
Yeah, valuation multiples were just expanding universally across the board.
Right. But in a higher rate environment, the industry bifurcates. It splits into that K shape.
Let's talk about the downward arm of the K first. Who is down there?
The downward arm is filled with firms that heavily utilized floating rate debt to acquire, say, software companies at 20 times revenue back in 2021.
Ouch. Yeah, that's going to hurt right now.
Because now the debt service is just eating all the cash flow. The valuations have compressed massively, and they can't sell those assets without taking a massive write-down on the fund.
And because they can't sell the assets, they can't return capital to their limited partners.
Exactly. And if you are a pension fund and your private equity manager isn't sending you cash distributions, you are definitely not going to commit new capital to their next fund.
Right, you're shutting them off.
So that manager just enters a state of complete paralysis.
Right.
They are trapped on that unhappy part of the K.
The unhappy part of the K, I like that. But Nuttall insists KKR is operating on the upper happy part of the K. They are actively taking market share from those struggling competitors.
And the data from this transcript completely backs that up, especially when you look at exits.
Yeah, let's look at the exits. Because while competitors are stuck holding assets, KKR reported the largest monetization quarter in its entire history.
Which is just wild in this environment.
It is. They realized $848 million in performance income. So how are they achieving this kind of liquidity? Like, who is actually buying these assets when financing is so expensive?
Well, they're utilizing a highly diversified exit strategy. They aren't just relying on the traditional, sponsor-to-sponsor buyout where one private equity firm sells to another using a massive syndicated loan.
Because those are exactly the deals that are nearly impossible to finance right now.
Right. So instead, KKR is selling to strategic buyers. These are corporate acquirers who already have really strong balance sheets and are looking for bolt-on acquisitions to grow their own businesses.
So they're selling to actual companies, not just other financial engineers.
Exactly. They are also utilizing the secondary markets pretty heavily. And in some cases, they're even tapping into the public markets, where valuations for high-quality, truly profitable businesses have actually held up quite well.
And the returns on these exits are staggering. The transcript noted they were generating returns ranging from 2 times to up to 20 times their original invested capital.
A 20x multiple. I mean, that implies they were selling assets from older vintages, investments they made 5 or maybe 10 years ago that have just compounded significantly over time.
And that vintage diversification is really the core advantage of a mega cap firm, isn't it?
Oh, absolutely. They have investments maturing across all different economic cycles. So they aren't forced to sell their 2021 deals today. They can sell their 2015 deals.
Right. And when you realize those outsized multiples and actually wire real cash back to your clients, your sovereign wealth funds and endowments, it creates this immediate flywheel effect for fundraising.
It is the ultimate proof of concept. In an environment where capital is scarce across the board, actually returning liquidity to your clients is how you dominate the next fundraising cycle.
Yeah, that makes total sense. But the institutional side is really only half the story here, because the other major industry headwind we constantly hear about in the media is the retail investor panic.
Right, the supposed mass exodus.
Yeah. The narrative is that all these high net worth individuals who bought into semi-liquid private market vehicles are just rushing for the exits. They're demanding redemptions because they can get 5% risk-free in a standard money market fund.
And to be fair, we have certainly seen isolated stress in the market with that, particularly with certain non-traded real estate investment trusts, the REITs, where managers literally had to gate redemptions.
Basically locking the doors so investors couldn't take their money out.
Right. But KKR's private wealth segment, which they call their K-series, tells a completely different story in this transcript.
Okay, let's hear the numbers.
Their wealth assets under management actually jumped 70% year over year.
70%?
Yeah, up to $42 billion. And they had $3 billion of new capital raised just in Q2 alone.
Okay, wait, we have to unpack that 70% AUM growth, because how much of that is actual net new inflows versus just the underlying assets appreciating because we're in a rising equity market?
It's a mix, but the underlying asset appreciation plays a smaller role than you'd think.
Yeah.
The primary driver is robust net inflows. They actually reported year-to-date net inflows of over 20% just in this specific segment.
Wow. Okay, so people are actively pouring money in.
Yes. And that all provided some really good context on why they're avoiding the redemption wave that's hitting their competitors. It fundamentally comes down to product construction and their distribution strategy.
How so? Like, what are they doing differently with the products?
Well, a lot of the industry stress has been in commercial real estate and highly leveraged private credit, right? But KKR's K-series is heavily weighted toward traditional private equity and infrastructure.
Ah, okay. So it's less exposed to the empty office building crisis.
Exactly. Furthermore, Nuttall really emphasized their massive investment in advisor education.
What does that mean in practice?
The friction in retail private markets usually happens when investors just don't understand the liquidity mechanics of what they actually bought.
Right. They think they can sell it on a Tuesday like an Apple stock.
Exactly. A semi-liquid fund is not a daily traded ETF. So KKR runs these global KKR academies, and they directly educate the 220,000 financial advisors in networks like Capital Group.
Wait, 220,000 advisors?
Yeah. By doing that, they ensure the end client actually understands the duration of the investment before they buy in. And money that goes in with the correct expectations simply doesn't panic sell at the first sign of macroeconomic volatility.
That partnership with Capital Group is just a massive distribution moat. It essentially plugs KKR's alternative products directly into one of the largest retail advisory pipelines in the entire world.
It's huge.
But okay, while they are scaling their traditional wealth products, the transcript also detailed a massive strategic pivot toward a completely new asset class. And we need to talk about this. The launch of Helix Digital Infrastructure.
Yes, this was arguably the standout strategic announcement of the entire earnings call.
Because everyone is talking about AI.
Right. We all recognize this global capital expenditure cycle happening right now around artificial intelligence. But while the public markets have been obsessively focused on the semiconductor layer, the GPUs, NVIDIA, all of that, KKR is focusing on the physical layer.
Because they recognize that the ultimate bottleneck for rolling out AI isn't just getting enough silicon chips. It's copper, it's concrete, it's the physical electrical grid.
Exactly. To run these massive large language models, the hyperscalers like Amazon, Google, Microsoft, they need data centers with just unprecedented power density.
Right, they are power hungry. So KKR launched Helix to build this out. And they launched it with an initial commitment of $10 billion.
$10 billion to start, yeah. And crucially, this is structured as a perpetual open-ended vehicle, not a closed-end fund with a standard 5 to 7 year lifespan.
Okay, why does that perpetual structure matter so much for this specific strategy?
Because building utility-scale power generation, or laying thousands of miles of fiber optics, or constructing these gigawatt data centers, that takes years just to permit and build, and then decades to depreciate.
Right, you can't just flip a nuclear power plant in 4 years.
Exactly. You cannot finance that effectively with a fund that needs to return capital to investors in 5 years. So a perpetual vehicle allows KKR to match the incredibly long duration of the physical assets with long duration capital.
They essentially want to become the premier landlord and utility provider to the entire AI revolution.
That's exactly it. And to execute that, they didn't just, promote an internal real estate partner. They brought in Adam Selipsky to lead Helix.
Which is crazy,
right?
Because Adam Selipsky is the former CEO of Amazon Web Services.
Yep, AWS.
That is just a fascinating maneuver, because Selipsky doesn't just understand cloud architecture in theory. He understands the exact procurement bottlenecks of the hyperscalers, because he spent years running the largest one on the planet.
Right. He knows exactly where AWS, Azure, and Google Cloud are totally starved for capacity.
So by pairing Selipsky's operational insight with KKR's existing, $120 billion global infrastructure platform.
Yeah, massive platform.
They completely bypass the traditional learning curve.
Exactly. They already own renewable energy assets and digital networks globally. So Helix simply reorients and scales that existing capacity specifically for the AI build-out. And they also noted strategic partnerships on the call with NVIDIA, Vistra, and the Kuwait Investment Authority.
Wow, that's a heavyweight lineup.
They are essentially assembling this consortium of capital, hardware expertise, and power generation to solve the most complex physical constraint in modern technology.
It's basically a classic infrastructure play, but totally adapted for the 21st century. Instead of building toll roads for cars, they are building the digital toll roads for AI compute.
Perfectly said.
So the narrative of a frozen private market clearly doesn't apply here. They're monetizing legacy assets at high multiples, they're capturing retail market share, and they're funding the physical backbone of AI.
They're staying very busy.
They are. But let's transition to part 3 here. What management is signaling about the future? Because the Q2 numbers, while incredibly impressive, are inherently backward-looking.
Right. We need to know what's next.
We need to evaluate the visibility of their forward earnings. And based on the outline we're working from, the most critical metric for that visibility is their shadow backlog.
Yes. The shadow backlog is essentially their deferred revenue engine.
Explain how that works for someone who might not be deep into PE accounting.
Sure. When a large institution, say a massive pension fund, commits capital to KKR, they don't actually start paying a management fee on day one. That capital basically sits in reserve, which is commonly referred to as dry powder, until KKR officially activates the investment period of the fund or actually deploys that capital into a specific deal.
Okay, so it's committed, but not yet earning fees.
Exactly. And the transcript shows they currently have a record $72 billion of committed capital sitting in that shadow backlog.
$72 billion sitting in the waiting room. That is an enormous amount of pent-up earnings power.
Huge. And CFO Rob Lewin actually stated that the weighted average management fee on this specific backlog is roughly 90 basis points.
Okay, let me do the math. So that means there is an embedded recurring revenue stream of nearly $650 million just waiting to hit the income statement.
Yes. And because of that 70% margin we discussed earlier, the vast majority of that $650 million will drop straight to their operating profit.
That is essentially locked-in future revenue. But, this raises a really critical question about incentives. Well, if you are sitting on $72 billion that isn't generating fees yet, there has to be massive internal pressure to just deploy that capital.
Right.
Do they run the risk of lowering their underwriting standards just to put the money to work and activate that revenue stream?
It's a very fair point.
Because if the M&A market is tight and you have billions burning a hole in your pocket, the temptation to overpay for an asset must be immense.
That is definitely the structural risk in private equity. You see it all the time. However, KKR's deployment pace has historically been highly disciplined. And the reason for that is they are not forced to deploy capital equally across all markets.
What do you mean?
Because they operate a global multi-asset platform, they can pivot their deployment to wherever the risk-adjusted returns are best at that specific moment.
Ah, I see.
So if European private equity happens to be overvalued, they can just funnel their deployment into Asian infrastructure or U.S. private credit instead.
They have flexibility.
Exactly. The shadow backlog isn't just a ticking clock forcing them into bad deals. It's more like a reservoir of capital they can deploy strategically as market volatility creates pricing dislocations.
And according to the numbers, they are refilling that reservoir faster than anyone anticipated.
Much faster.
Back at their investor day in April 2024, they set a target to raise $300 billion over a 3-year period. But according to this transcript, they hit $305 billion in just 2.5 years.
Yeah, including $34 billion in Q2 alone.
They crushed their own mega target with 6 months to spare.
That velocity of fundraising completely changes the fundamental scale of the business. And it's really important to note where this capital is actually accumulating, because it's not just flowing into traditional leveraged buyouts anymore.
Right. The transcript highlighted massive growth in their strategic holdings and their insurance platform, Global Atlantic.
Which really represents the evolution of KKR from a pure asset manager into a highly diversified financial conglomerate.
Okay, let's dissect the strategic holdings first, because the guidance here is aggressive. For anyone unfamiliar, this is a portfolio of operating companies that KKR owns directly on its own balance sheet, which they refer to as core holdings.
Right, they own them outright.
And the cash flow from these businesses goes directly to KKR shareholders, not to their fund limited partners. Now, over the trailing 12 months, they generated $187 million in operating earnings from this segment.
Pretty solid.
But management stated on this call that they expect this to scale to over $1.1 billion by 2030.
Which is a nearly 6-fold increase in just 4 years.
Exactly. And I have to push back on that projection. I mean, to scale physical operating businesses that aggressively in a macroeconomic environment where the cost of debt is hovering around 7 to 8%, that is incredibly difficult.
It is a very bold claim.
Are they relying on massive multiple expansion to hit that number? Or are they modeling in highly leveraged debt-fueled acquisitions for these core holdings? Because if it's the latter, that $1.1 billion target carries significant execution risk.
It's a completely valid skepticism, because scaling operating earnings at that kind of velocity usually requires a ton of leverage. However, Lewin actually addressed the durability of these projections on the call.
What was his defense?
He pointed out that this isn't a single concentrated bet. It's a diversified portfolio of roughly 20 different businesses. And because KKR owns them directly, they control the capital structure completely.
Meaning what?
Meaning they aren't bound by the typical 5-year hold period of a traditional private equity fund. So they can compound the cash flows internally and reinvest in organic growth over a much longer horizon, rather than relying solely on financial engineering and taking on debt.
Okay, so a longer runway for growth.
Exactly. Furthermore, Lewin noted they continually stress test these projections against technological disruption, specifically AI, and they remain highly confident in the portfolio's resilience. So the $1.1 billion target is aggressive, yes, but it relies on compounding cash flows across 24 scaled enterprises, not just one macroeconomic variable swinging their way.
Okay, so it's a compounding engine on their own balance sheet. I can see the logic, but the true behemoth on their balance sheet is Global Atlantic, the life insurance and annuity provider they acquired.
Absolutely. This is massive.
We really need to explain the structural mechanics of why an alternative asset manager actually wants to run a life insurance company, because it dictates a huge portion of their future earnings power.
Yeah, the strategic logic of owning Global Atlantic revolves entirely around the concept of float.
Right.
So when an individual purchases a life insurance policy or a retirement annuity, they pay premiums to Global Atlantic today. But Global Atlantic guarantees a payout decades in the future.
So they're holding on to the cash in the meantime.
Exactly. The massive pool of capital that accumulates in the interim. That is the float.
And that float has to be invested somewhere. Global Atlantic needs to generate a yield on those assets that is higher than the interest rate they promised to pay the policyholders.
Precisely. Now, historically, traditional insurance companies invested that float in highly liquid, low-yielding public corporate bonds or treasuries. Very safe, very low return.
Right.
But by integrating Global Atlantic into KKR, they create this incredible closed-loop system.
Right.
Global Atlantic originates the long-duration liabilities, the sticky capital from retirees. And then KKR takes that float and deploys it through their asset-based finance, or ABF, platforms directly into private credit, real estate debt, and infrastructure loans.
And these private assets carry an illiquidity premium, meaning they yield significantly more than public bonds of similar credit quality, simply because you can't sell them as easily.
Right. And because Global Atlantic's liabilities are so long-term, the transcript actually noted 99% of the liabilities they originated in Q2 were at least 5 years in duration. They just don't need daily liquidity.
So they can afford to lock the capital up in private credit to capture that spread.
Exactly. It is the exact structural advantage that Warren Buffett utilized by acquiring KKR Co to build Berkshire Hathaway.
The ultimate playbook.
It really is. You acquire a machine that generates cheap, permanent capital, and you pair it with a world-class investment origination engine. And KKR has built a massive engine to feed Global Atlantic. They have 20 proprietary ABF platforms with over 7,000 employees globally, dedicated solely to sourcing these asset-backed investments.
7,000 employees just sourcing debt. That is wild. And the economics they reported from the segment are staggering. Total insurance economics hit $2 billion net of compensation over the trailing 12 months. That's up 13% year over year.
Yeah, it's a huge profit center.
But there is a really crucial accounting nuance here that suggests they're actually underreporting the true earnings power of this portfolio. Lumen mentioned their very conservative approach to mark-to-market accounting.
Yes. This is a critical detail for anyone trying to value the firm. KKR reports Global Atlantic's operating earnings largely based on realized cash outcomes.
Okay, so actually cash in the door.
Right. They do not run the unrealized, paper gains of the underlying alternative investments through the income statement in the same way some of their peers do.
And Lewin stated that if they did include the mark-to-market impact, the insurance operating earnings would have been north of $600 million year to date, which is substantially higher than the $288 million they actually reported.
Exactly. They're essentially hiding hundreds of millions of dollars in embedded value off the P&L.
Wow. It provides a massive cushion for future earnings. And interestingly, while traditional asset managers fear market volatility, KKR actually views it as a strategic advantage for Global Atlantic.
They absolutely do.
I want to dig into that because it seems counterintuitive. Why does a spike in market volatility actually benefit their insurance business? Wouldn't widening credit spreads hurt the value of their existing portfolio?
In the short term, sure, the paper valuations might fluctuate downward. But the structural mechanics of the business thrive on that volatility.
How?
When public markets get turbulent, credit spreads widen across the board. This means that as Global Atlantic continues to bring in billions of dollars in new premiums every single month, because retirees keep buying annuities regardless of the stock market, KKR can take that fresh cash and deploy it into private credit assets at significantly higher yields.
Oh, I see. They are locking in those higher returns for the next decade.
Exactly. And simultaneously, heightened volatility usually causes traditional standalone insurance companies to pull back. They get defensive, they stop writing as much business.
But KKR doesn't have to.
Right, because KKR has that massive 7,000-person origination engine. They don't have to retreat. They step in when others step back. which allows them to dictate better terms, demand stronger covenants, and command higher yields on both sides of the balance sheet.
They are structurally engineered to capitalize on macroeconomic stress. That perfectly explains their confidence right now in the face of such a complex rate environment.
It's a huge competitive moat.
It really is. But there is one more massive growth vector outlined in the management guidance, and it involves a relatively new frontier for institutional capital. The business of sports and GP solutions through their recent acquisition of Arctos.
Yeah, Arctos is just a fascinating addition to the KKR ecosystem. They currently manage roughly $20 billion in AUM, and they are the undisputed pioneer in sports-related investing.
Which is wild because we've seen a massive shift in how professional sports franchises are capitalized recently. Like historically, buying an NBA or a Premier League team was basically a vanity project for a single billionaire or small family office.
Right, it was a hobby for the ultra-rich.
But the valuations have just exploded. When an NBA expansion franchise commands a $4 billion valuation, the pool of individuals who can actually write that check shrinks dramatically.
And even the billionaires who do own these teams often need liquidity.
Right.
Like they want to build a new billion-dollar stadium, or maybe a minority partner wants to cash out, but the primary owner doesn't want to sell their controlling stake to buy them out.
So what do?
Arctos recognized this huge structural need for institutional capital in the sports ecosystem. So they provide minority equity and customized liquidity solutions directly to these franchises.
They're becoming the bank for sports teams.
Essentially, yes.
But Arctos isn't just about sports. The transcript highlighted their role in what they call GP solutions. We need to clarify this mechanism because it's super insider baseball. A GP, or general partner, is the firm managing the private equity fund, right? Like KKR itself, or thousands of smaller middle-market private equity shops.
Correct.
So why does the GP itself need capital?
It's a really dynamic part of the secondary market right now. Often, a mid-sized private equity firm wants to launch a new, much larger fund. And to align interests, their institutional investors require the GP to commit a significant amount of their own personal capital to the fund.
That's the GP commit. Skin in the game.
Right. But the partners at that firm might have all their personal wealth tied up in the illiquid assets of their previous funds.
Ah. So they are asset rich, but cash poor.
Precisely. They have paper wealth, but they can't write a $50 million check for the new fund. So Arctos steps in and provides capital directly to the GP management company. Or they buy minority stakes in the GP itself, providing the liquidity they need to scale their business or fund those commitments.
It's essentially providing private equity to private equity firms.
This is exactly what it is. It's PE for PE.
And KKR just launched the inaugural Keystone Fund through Arctos to execute the strategy, and they closed it at over $6 billion.
Huge debut fund.
So the demand is clearly massive. Scott Nuttall explicitly stated that across the three pillars of Arctos Sports, GP Solutions, and traditional secondaries, they intend to scale this business to over $100 billion of AUM over time.
Going from $20 billion to $100 billion is a massive leap. But, it aligns perfectly with their broader strategy of finding these complex, capital-starved ecosystems and just dominating them with scale.
Okay. We have covered an immense amount of ground here.
We really have.
We've dissected the 70% FRE margins, the shared services architecture, the K-shaped market, the exits, the massive pivot into AI infrastructure with Helix. We've looked at the shadow backlog, strategic holdings, the global Atlantic float machine, and now Arctos.
It's a lot of data.
It is. So now we arrive at part 4, the critical synthesis, the bottom line. Based on the operational data, the forward guidance, and the specific mechanics detailed in this transcript, what is the actionable takeaway for the stock? Are we bullish or bearish?
Well, the operational performance is unequivocally strong, so I'm bullish. But to fully grasp the bullish thesis for KKR's stock, we really have to examine a highly specific structural accounting change they announced in this transcript.
Right, I teased this earlier.
Yes, and this change alters the fundamental earnings power of the firm on a per-share basis.
This is exactly the nuance that separates retail observers from institutional analysts. So walk us through this accounting catalyst. It involves the K series, right? The private wealth vehicles we discussed earlier.
Yes. So historically, when KKR earned performance fees from the underlying investments in those K-series private equity funds, that revenue was categorized on the income statement as realized performance income.
Okay, so it was treated just like the performance fees generated from their massive institutional buyout funds.
Exactly the same. But management announced a strategic reclassification. Moving forward, the realized performance fees specifically for these private equity K-series vehicles will be reported in a different line item called Fee-Related Performance Revenues, or FRPR.
FRPR. Okay. But on the surface, moving revenue from one accounting bucket to another seems entirely semantic. I mean, the gross revenue coming into the firm hasn't changed at all. Why does the stock market care which line item it sits on?
Because the line item dictates how KKR distributes that revenue internally. This is where the mechanics of compensation dramatically impact shareholder value.
Okay, break that down.
Under the old classification as realized performance income, a significant percentage of those fees, often up to 60 or 70% across the industry, was allocated directly to the bonus pool for the deal makers and executives.
Right, the classic eat what you kill Wall Street compensation model. The people who sourced and exited the deals took the lion's share of the profit.
Exactly. But by shifting this revenue to the FRPR classification, KKR is structurally altering that compensation ratio. Revenue categorized as FRPR is subject to a much lower fixed compensation rate.
Modeled in the transcript at just 15 to 20%.
Right.
That is a massive mechanical shift in profitability. They essentially capped the bonus pool on these specific retail wealth fees.
Yes, they did.
By slashing the percentage of the revenue that gets paid out as cash compensation to the employees, a vastly larger percentage of that revenue flows directly down to the bottom line as corporate profit.
Exactly. CFO Rob Lewin didn't even try to obscure the impact of this. He stated plainly on the call, and I quote, "Given the compensation rate impact, all else equal, this change structurally increases KKR's forward earnings per share."
Structurally increases forward EPS. Yeah. That is the fundamental driver of equity valuation right there. They engineered a mechanism to make the corporate entity substantially more profitable on a per-share basis without having to generate a single extra dollar of top-line revenue.
It functions mathematically very similarly to a massive corporate stock buyback. But instead of reducing the share count, they are permanently expanding the profit margin on a rapidly growing revenue stream.
It is a brilliant piece of corporate financial engineering, but honestly, it demands a really crucial question because private equity is an intensely competitive industry built on incredibly aggressive compensation.
Oh, the egos and the paychecks are massive.
Right. The deal makers at KKR are fiercely intelligent and highly sought after by Apollo and Blackstone. So why would the partners and employees willingly agree to an accounting change that structurally caps their cash compensation on these specific funds? I mean, they are voluntarily giving up a huge piece of the profit pool.
That is the most important behavioral signal in the entire transcript, but they aren't doing it out of charity.
No, Wall Street doesn't do charity.
They are doing it because of how the firm is capitalized. The employees at KKR hold an astonishing amount of the company's outstanding equity.
The transcript notes that KKR employees own approximately 30% of the firm's stock.
30%.
30% insider ownership for a mega-cap financial institution is almost unheard of. Let me put that into perspective for you, the listener. The average S&P 500 company has about 2% insider ownership. KKR's employees own 30%. It changes the entire incentive structure.
Completely. When you own 30% of the company, you stop optimizing for your year-end cash bonus, and you start optimizing for the long-term compounding value of those shares.
Lewin actually explicitly connected this accounting change to their insider ownership on the call. He noted that the ownership mentality fundamentally shapes how they think about long-term value creation.
The partners at KKR ran the math. They realized that by capping the cash compensation on the K-series fees, they would significantly boost the firm's EPS.
And a higher, more predictable EPS drives multiple expansion in the public markets, pushing the stock price way higher.
Exactly. The massive increase in the value of their 30% equity stake far outweighs the cash they gave up in the bonus pool.
It is the ultimate manifestation of alignment. They are fundamentally managing this firm like owners, and they are literally telling the street they're perfectly happy to, let the numbers do the talking.
Right. So when you evaluate KKR as an investment, you aren't just betting on their ability to source infrastructure deals or manage insurance float. You're investing alongside a management team and an employee base that owns a third of the company and is aggressively engineering the financial structure to maximize the value of those shares.
The confluence of these factors is just incredibly potent. You have a firm successfully executing a massive expansion into structural tailwinds like AI infrastructure with Helix and private wealth with the K series.
Right. They're insulated by a massive $72 billion shadow backlog.
They're supported by a highly conservative, extremely lucrative insurance float machine in global Atlantic.
And they're driven by a management team willing to optimize the accounting structure to drive EPS growth.
It is a highly robust operational picture. Which brings us to a final, broader implication of this transcript. As we wrap up here, I want to leave you with a provocative thought. We started by discussing the macroeconomic narrative, right?
The idea that the private equity industry is frozen.
Struggling with high rates and a complete lack of liquidity. And Scott Nuttall defined this as the K-shaped market, with KKR firmly on the upward trajectory while competitors languish on the bottom.
The divergence in performance is just stark.
But if we extrapolate the mechanics of a K-shaped market over a multi-year timeline, it inevitably leads to a massive structural consolidation of the industry.
The strong consume the weak.
Exactly. For the past 20 years, the private equity industry supported thousands of middle market firms. As long as debt was cheap, everyone could raise a fund and generate a return. You just levered up and waited.
But if we are entering a sustained period where only the mega managers have the balance sheet to build $10 billion perpetual AI infrastructure vehicles,
and only the mega managers have the retail distribution networks with Capital Group to raise billions in private wealth,
then the ecosystem fundamentally changes. The barriers to entry, and more importantly, the barriers to scale, have never been higher.
A mid-sized firm simply cannot replicate the 7,000-person asset-based finance origination engine that KKR built for global Atlantic. They just can't.
And they certainly cannot recruit the former CEO of AWS to run their infrastructure fund.
Right. If KKR is successfully raising $34 billion in a single quarter, while smaller competitors are literally starving for capital and unable to exit their underwater 2021 vintages, we are likely watching the beginning of an era of unprecedented consolidation.
The alternative asset space might evolve to look a lot more like the global accounting industry or the bulge bracket investment banks.
Dominated by an oligopoly of a few absolute titans. KKR isn't just surviving this difficult macroeconomic environment, they are utilizing their massive scale to permanently separate from the pack.
It is a really compelling thesis. And the data in this Q2 transcript certainly supports the narrative that the gap between the apex predators of private finance and the rest of the industry is widening aggressively.
Structural advantages are just compounding. So as we close out this analysis, the key metric you need to watch moving forward is the deployment velocity of that $72 billion shadow backlog.
Yep, keep your eyes on that number.
The capital is locked in, the margins are totally optimized, and the compensation structure has been engineered to benefit the bottom line. Once they begin activating those fees at scale, their earnings engine shifts into an entirely new gear.
The foundation they have built across infrastructure, insurance, and wealth management provides multiple, totally uncorrelated levers for growth.
And that is exactly why we bypass the broad, generalized market narratives and dive directly into the raw data and operational mechanics of these transcripts. Because when you look closely at KKR's actual operating model, the architecture is designed to scale regardless of the macroeconomic weather.
Thank you for joining us for this deep dive.
Keep analyzing the mechanics behind the headlines, and we will see you on the next deep dive.